Hello everyone, I'm Ted Oakley, Managing Partner here at Oxbow Advisors with our quarterly call. And the second quarter, not unlike the first quarter, was just as volatile, just the other way. It's been an interesting time, and we've had 6 extremely months of volatility, with the least volatile actually being the month of July so far. So let's get to some of our themes if we could right now. And we go to themes that have been working for us over the last couple of years. But you'll notice on the bonds, for example, that we spent the better part of 2 years owning long-term bonds. Our maturities were longer than most people. A lot of the treasuries we own were 20 years and 30 years. And we made a lot of money on those over the last 18 months up until about March of this year. And at that time, we felt like we had gotten about all we could. And so now you're seeing us shifting to much, much shorter maturities than we had before. You'll also notice with stocks, and you'll hear more about that later on in about 3 weeks from Chance Finucane, our Chief Investment Officer, who has a really great report coming on the stock side. But on the stock side, we still buy the companies we think have consistent earnings. We still buy the ones we think have consistent dividends and low debt. And you'll see that we've had really good returns this year, even with about 30% liquid, just because we could not find enough things to buy. You'll also see that we've always had a gold position in the high income accounts. We don't carry it in the stock accounts, but the others we do. And what you'll find is that we've had a position in that for some 5 years. And then we went back around the first week of March and we increased it. That was 5 months ago. We increased it because we felt like what the Federal Reserve was doing was going to end up with a situation where the currencies were going to go into disarray, which they have. So we increased the gold side of that. We'll talk more about that later. We're not necessarily saying you should do that now, but give you an idea of what we've been doing. And then we still have a fairly sizable cash position, only because the things we think are great buys we already own, and we're not just going to buy other things so we say we own something. So that's where we are at this point. Let's take a look at the economy. And one of the things you're going to see in this particular graph is that basically what you're going to see is 92% of the economies of the world are in recession, which is, take a look at that. 1931, 83%. You look back at 2009, it was about 61%. So a lot of countries are in recession right at this point in time. Secondly, look at unemployment claims. We have approximately 34, 35 million people today that are on continuing unemployment. And they're receiving about 20% of the wages of the entire country, and that's while unemployed. We haven't had this number in many, many years. In fact, it's an all-time record, actually. This is a very, very high number of people that are on continuing unemployment. That just means that they've stayed unemployed for a longer period of time. One of the things we notice out there is the mood of people and what they're saying and what they're doing, how they're feeling. And we came across this Pew Research piece that had done a great study just recently on how people were feeling. And if you'll notice, the number one thing here is they are angry. 71% of the people are angry. 66% felt like they were also fearful. And I think that pretty much spells out the way we see people that we do business with, or people in the country right now as well. Whether we work with them or not, we find that to be something that's normal. And then the last thing was you'll see is that only 17% felt proud. I'm disappointed in that. I'm sorry that's the way it is, but I do think it's real. I think that's the way it is right now. And if you'll look at the very last portion, you'll see where basically people, 87% of the people are dissatisfied with the way things are going. That tells you the makeup of what's happening. A couple of things that are bothering us right now. One is if you look at restaurants and how many restaurants are closed, permanent closures now. And obviously California, Texas, New York, and Florida are right at the top. But no matter what, these are a lot of restaurants. And you probably don't know this, but restaurants are one of the largest, if not the largest, employer in the U.S. Approximately 15% or so, and it's something to keep in mind. That's something we've been watching as well. That will have a lasting impact for a long time on the economy. Lastly, you hear a lot of talk about what's going on in commercial real estate. So it's, when you look at it, we really are in a position of where you have it skewed one way or the other. As an example, accommodation is about 24-25% of people in the accommodation business, hotel, motel, are behind on their payments, rental payments. The second one down would be the retail industry. And then if you look at office space, industrial, multifamily, which apartments, they're really not doing too badly. A little bit, they're up a little. I'm not saying they're not up at all, but we find that encouraging because that hasn't really dipped into that tough area. And overall, we're not a ton higher than we were back in 2012 if you look at the average overall. I think what we have to look out for is after the stimulus is passed, that puts us into the first part of 2021, okay? What happens then? I think that's when we get a true test of what's really going on in this economy. Lastly, we've really started to see bankruptcies go up, and you see them all the time. You know all the big names that file bankruptcy. But now we're starting to see a lot of mom and pops, a lot of small businesses file bankruptcy, and the bottom line is they just can't make it. You can't make it on 25 or 30% of the normal business level, so that makes it tough. So with that economic background and sort of seeing where things are going, what does that cause to happen? Well, one of the things it's caused, and this graph you'll see, is the dollar has been declining. Two things come out of that. When the dollar's declining, that means the things that you're buying, the prices go up. And one of the things we really are sort of standing by in it right now, and that's one of the reasons we've had gold in the portfolio, is because when you get in this situation like this, you get to sort of a stagflation level. As an example, we're in a recession. Companies aren't doing as much business as they were a year ago or 2 years ago, and yet the essential things that people buy are going up in price. And when the Federal Reserve floods the system with all this money, it causes the people who trade foreign currencies to say, hey, you know what? I think I'll pass on that dollar for a while. So here we have a situation, just to give you an idea, and you're probably not even aware of this, but most commodities are going up. Give you an idea. If you look at a couple of things that are happening right now, copper, new high, iron, new high, lumber, new high. In soybeans, even though it's not a new high, they come a long way back. And so I say to you to keep that in mind because it has an impact on really what happens. I think what people will probably miss here is that we're in a period of stagflation and you need to run your portfolios that way. I find people still trying to operate their portfolios as if it was 5 years ago, and it's not. We have a different time right now. The other thing that's happening to us, and I say this because this is unfortunate, is that we have too much debt. We have debt all the way around. If you look today, for example, at corporate debt, just take the corporations by themselves, their debt now is almost 50% of the entire gross domestic product that's produced. Just corporations. That's not counting the government. That's not counting people, individuals. And so what it's done, and give you an idea on the government side, if we pass a $1 trillion stimulus bill, that will put us at a 24.6% deficit for the year, fiscal deficit. If we pass $1.5 trillion, it'll be 27%. Both of those are getting close to what we had in World War II. And if you'll notice something, and this is important to notice, the Depression years were not near as bad as far as debt as a percentage of GDP. It was actually quite low. I think that was something that will really haunt us in the next 5 years. There's just too much debt everywhere. So if you look at what's happening then, I mentioned in the earlier portion about interest rates and what we were doing with the bonds. I want to give you an idea about what's happened. We started the year, like I said, we had spent about 2 years with some longer maturities. We liked the 20-year, the 30-year Treasury. We completely sold out of those in March. And so what we've been doing since that time is really trying to own things that are of a shorter term in nature. An example, if you take and look at a couple of things that are going on here, that 0.72% right there is a 10-year a 10-year municipal bond right now, a AAA municipal bond. That means you get 7.2% for owning it in the entire 10-year period. If you own a Treasury for the 10-year period, it's 0.6%. And if you want to go out and really do something special, go buy a 30-year Treasury at 1.3%. We think that is not the way to go here. And we find a lot of people driving into bond funds, which we think will really hurt them in the long run now, because bond funds stay fully invested. So the more money they get, the more they buy into the marketplace. And I see them doing this all the time, buying very, very low coupons, low interest rate returns. And as soon as rates turn eventually, and they may not turn the next 6 months, I don't know, but we think it's prudent right now, because if you look at what's happening, if I'm only getting on a U.S. Treasury 0.1% for 6 months, or let's say 0.17 for 3 years, why would I go on out? Why wouldn't I just stay within 1, 2, or 3 months and wait on that? That's what we're doing right now. If you see us moving some things around, you'll find that we hold those bonds in really short right now. So moving forward, we'll take a look at what's happening then in the stock market. Before we go into that, let me say one of the things that's been doing well really in the last 5 or 6 months is gold. Now, as I mentioned earlier, we had a gold position in our high income accounts for the better part of the last 5 years, but we added gold as well and a gold miner about 5 months ago. Now, we haven't added any more to that, and I don't think we would right here. Gold has hit a new high, and it would not surprise us. It's off a little bit today, and I think it could come in price here a little bit, come in a little bit lower. I'm not saying we wouldn't add some more, but I think we would have to get somewhat of a correction before we would add a lot more than we have at this point in time. One of the things that continues to happen right now are these big stocks, and you can see them here, still dominate the market. If you look at the Microsoft, Apple, Amazon, Facebook, Google, they dominate the market, much like these stocks, Microsoft, GE, Cisco, Intel, and Walmart did back in the year 2000. And you know what happened then. When the bloom comes off the flower here, there's a problem, okay? And I think what's happened is everybody's gotten so used to just owning these companies that they can't open their mind up to anything else to own right now. So a little look for you to look at and try to think about something. I put this graph up because I wanted you to see it. This was the Dow Jones Average, and it was this is over basically a 4-year period, and it made 300% over that 4-year period. Had you gotten in the market then, made 300% on your whole portfolio just by being in the Dow Jones for that 4-year period. And you say, when was that? And so that was 1932 to 1936. 1932 to 1936, and you say, well, why did you put that up there? And I say, because prior to that, from 1929 to 1932, the market had lost about 90%, 85 to 90% of the value. The point being is, you could make a lot of money during the Depression years, But there's one thing you had to have. You had to have some money. And everybody asks us, why do you carry some cash all the time? Well, one, everything's too expensive. And two, if you're going to be prudent today when everything is sky high, including bonds, you're going to have some sort of protection, something to fall on in case you get into one of these. And again, there was a lot of money to be made, but not if you didn't have any money. So if you were 100% invested in 1929, just like you would be in 2020, and you really have some kind of takedown on the market, you need some cash if you plan on doing anything with it later on. Lastly, I would tell you, I wanted to give you an example of some sort of the extremes that go on in the marketplace. This is a graph of the Nasdaq, which is all the big FANG stocks, the things you know, the four-letter stocks, that of when it was in January 2020 and where it was now. And you'll see, make this comparison now. The average itself is up 15%. But look at these things. The gross domestic product, what we produce in the country year over year, down 10.9%. Unemployment, 7.5% increase. Continuing claims, 16.3 million increase of people in that length of time. Debt to GDP ratio up 16%. And then you look at all of these interest rates that have just declined incredibly in that single period. And you put that together and say, why would that average be that much higher with this sort of thing going on in the marketplace? And there's a one-word answer, actually a two-word answer, Federal Reserve. That's the only reason it's come around. We said it all along that they are very detrimental to what's going on here. They're not thinking about what they do. They're not thinking about the debt levels that are out there. They just open the gate, pull the trigger, and they're completely backed up by both parties. And I think what's going on here will eventually be something that will be really tough for the U.S. So where does that leave us? Just in some closing thoughts, really. Number one, bond interest rates are at very, very low levels right now. As you saw on the graph I showed you how low they were. Stock prices are at very, very high levels right now. And I can use any metric you want to use, but that's what we're seeing. We still look for a lower dollar. We think that what the Federal Reserve is doing is going to really pressure the currency. And it's going to take the people that unfortunately need it the most, okay, which is the average person to the lower level person. They're going to be paying a lot more money for the essentials, a la commodities we talked about before. And I think you need to keep that in mind. We'll maintain our gold positions. I'm not saying we wouldn't add to them if we fall back in here some. We probably would, but right now we'll maintain what we have. We do expect volatility to stay high. I think all the way through the end of the year. We've got elections, and you'll see that we'll maintain a high cash position unless we find things that are cheap, but I can't see that coming right now. As I close out today, I just want to let you know, number one, thanks for listening in and looking in at what we're doing. If you have any questions, certainly get in touch with us. Let us know what you're thinking. But I want to remind you that in approximately 3 weeks, Chance Finucane is going to be having a part of the investment series. It's not a quarterly call. It'll be like we had at our summit last year, and he'll be talking about our systems and what goes on, what we look at right now, and some principles of what we do. I think you'll find it really, really interesting. So try to tune in for that. And so with that, anything you have and you want to know, certainly give us a call or come and see us at oxbowadvisors.com.